Are you looking to start saving and investing for your future but don't know where to begin? Well, stick around. That's what we're going to talk about in today's video. I'm going to talk about where you can open an account, how to open an account, how to buy some stocks, and just get started in investing and saving for your future. So, good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Sunday, October 22nd, and thanks for joining me. I really appreciate you guys stopping by and watching my video. Before I forget, do me a favor, hit that like button, hit the subscribe button. I really appreciate the help. That's how YouTube's analytics work and how their algorithm works. I know you guys have heard that from a lot of people, but that really goes a long way in helping to grow the channel, which is my goal. And it helps me out and it helps other viewers try to find the content, which is really the ultimate goal. I hope that the content I provide is interesting and helps to teach people a little bit. I really do. I like this stuff and I find it really interesting. So I hope that by sharing, others can learn some things and maybe start investing and saving for their future. So let's say you want to start investing, but you really have no idea where to begin. It really isn't that tough. A lot of people in the industry make it sound much more complicated than it really is. So I'm going to put a couple links in the description for opening an account with SoFi. If you open an account and deposit more than $10, they're going to give you a $25 bonus. When I've clicked on the link myself, it brought me to a screen that said something about getting as much as $275. I don't know what they're promoting to get those additional bonuses, but I know it's available. I didn't follow those links. The other thing is if you get the bonus, we also get a bonus for an account that I opened for my son. He's 12 years old. He gets really excited when that happens. So I appreciate the support and I appreciate that as well. But I start with that partially because that's one place you can open an account. It's really simple. It's just like opening up a bank account or anything else. You can also go to Fidelity or you could also go to E-Trade and some of the others. There's also Ameritrade, and they're all just fine. And it pretty much just asks for your basic information, your name, your address, your date of birth, your social security number, and they'll get an account opened up for you. And then funding it is really simple too. There are a few different ways you can do that. I'm sure you can send a check in that notes your information, the account number they provide you, and everything else. They'll also have links that'll directly attach to your bank account so that you can do direct deposit into them as well. If you're curious where I've opened accounts, I've opened an account at SoFi. I also use E-Trade. I think they're both good platforms. And part of what I like about them is it's free to trade on there. I'm not real keen on the exchange traded funds that people talk about. They also call them ETFs for short, and it might sound confusing. What some people like about them is they're a compilation of a whole bunch of different stocks wrapped up into one. So if you just wanted to buy the S&P stocks, you can buy what's called the SPY, and it trades just like another stock, and it's a compilation of all the 500 stocks that go into the S&Ps. What I don't like about those is I find it fun to pick my own stocks, and on top of that, when you buy the exchange traded funds, you're getting everything, which means you're getting all the companies that you don't want to. And I think it's really easy to look at it around the world, see the things we buy, see what we use, see where we like to shop. And pretty much everything that you use in daily life, or a lot of things, have stocks and they trade on the exchanges, which is why I say it's really easy to do. Now, once you get your account opened and you've put a little bit of money in it, you really don't need a lot. The world has changed so much. So when I was younger and first started looking at this stuff, you went to a brokerage account where a guy would help you do all of it, and they would charge an awful lot of money to buy and sell stocks. I don't remember what stock it was, but one of the stocks I bought early on, I bought 100 shares of, and it was like a $40 stock, so I put $4,000 in it, and when I got the receipt for the purchase, because that's how they did it, it came in the mail. I noticed that the commission to buy that stock was almost $300. Well, today those commissions are usually free. The companies like E-Trade and Ameritrade and Fidelity, they sell the order flow to a trading company and they get paid that way for the trades essentially, which allows you to potentially buy one share of a stock and it doesn't really cost anything than the price of the stock. So stocks have what are called ticker symbols. It's either three or two or four letter acronyms for the stock. And if you have a company you like that you want to buy, all you need to do is go on Google, type the name of that company in, and say, blah, 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 stock ticker. And it'll tell you what the stock ticker is. And that's how, when you're on your web page, if you wanted to search for the company you want to buy, you find it and look it up. My suggestion is don't overthink it and don't make it more complicated than it is. Now, you don't have to listen to me, nor do I encourage that. I encourage you guys to do your own research so that you make your own financial decisions. I am just a guy on YouTube. I'm just sharing some of my experience. So, by all means, you have to make your own financial decisions. But with that, I'm going to tell you a little bit of a story when I was a kid and part of what got me into this. Now, for whatever reason, just like everybody likes whatever they like, I always found the markets fascinating and I always wanted to be involved with them. I do not know why. That's just a little bit of who I am. But when I was 17 years old and my grandfather was getting older, and I've told this before, but I know a lot of you are new to the channel and probably didn't get too far into the information, so you may not have heard the story. And if you have, feel free to scroll past this and watch the rest. I was fortunate enough that when my grandfather was getting older and he was worried about, his mortality, he gave all of his grandkids a $10,000 gift. Super fortunate, super lucky. Well, there are four kids in my family, and my mom didn't want any of us to have that money because this was like late 80s. That was a lot of money, and she didn't want us to spend it or waste it the way that typical kids were. And I got really upset and I went in and kind of argued, like, Mom, I want that money. And she looks at me confused and she's like, Why? What do you want it for? And my answer was, I want to buy stocks with it. So she's totally surprised. She doesn't know what to expect to some degree. And she kind of says, Well, do me a favor, write down on a piece of paper the stocks you want to buy, and we'll talk about it. And sure, you can use the money to buy some stocks. So I wrote down five stocks on that piece of paper. I might have written some more, but I know I narrowed it down to five stocks that I was going to put $2,000 each in. And one was Chrysler, one was Eastman Kodak, one was General Electric, one was McDonald's, and for the life of me, I can't remember the fifth one, which drives me nuts. The interesting thing about that, and this is why I say don't overthink it and just find the companies you find interesting. Don't worry about their valuations. Maybe they're too expensive today, maybe they're a great deal. But the point of the story is we're now 35-ish years later. Chrysler went out of business. Eastman Kodak went out of business. The GE that you see trading, or General Electric that you see trading today, is not the one from back then. They changed it all, and I'm pretty sure it went out of business for what I paid for it to. Now, I did collect some dividends for some time, and it went up and down. But the point of the story is McDonald's, which when I bought it, I had already heard stories of, my so and so's grandmother put $1,000 into McDonald's however many years ago, and now she's millionaire worth tons of money. So it's not like I'm one of those stories that I bought McDonald's early on in its career. It was already really established by the late 80s. Well, if I had kept that stock, and I looked it up, I don't know if it's three times or four times, but let's go with it split three times. I don't still have the stock. I do have 100 shares, I won't lie, but I don't have what I wish I had because I was a kid. And every time it's split, so this, what a stock split is sometimes they give you twice as many shares, but the stock falls in half when they do that. So I bought McDonald's around $20 a share. I had bought 100 shares. It went up to maybe 40. they would announce a split. I would then have 200 shares, but the day you got the 200, it was back to 20. Well, I was all too excited to sell 100 shares, feel like I had $2,000. I know one time I bought a computer and something else with it and go on. Well, if I just stuck with it, my 100 shares would have been 200, then 400, then 800. And I think it actually would be 1600, but let's just stick with the 800. Well, McDonald's is trading $260 a share as of the close on Friday. I'll take $10 off of that just to make the math easy. 800 shares at $250 a share is $200,000. So that $10,000 investment, even with four of the companies going bankrupt, has turned into $200,000. But remember, that's over 35 years, which is why I say I try to invest for the long term, not for the short run. That's also why I don't try to worry about if I'm overpaying, if I'm underpaying, if the stock's valued fairly, or anything like that. When I was 16, 17, 18 years old buying those stocks, I had no idea about any of it. I just picked what I thought were well established companies and put some money into it. And I think that's really good return for some really bad choices. I mean, Chrysler did terribly. Eastman Kodak did terribly. Most of the stocks I picked did not do so great. They were just well-known brand names, and I think that works through today. If you just stick with good, well-known brand names, it really doesn't have to be the ones I pick or anybody else. You just stick with things you know. And hopefully, over 35 years, one or two of them have done extremely well. It's not a matter of digging for the best or the greatest. Now, I'll give some stock tips of some ones that I like as we move along in the video. But that's kind of where I want to comfort people that you don't have to be any genius. In fact, I try to dumb it down and I don't like I'll do the research, but I do try to ignore some of it too because I also feel like some of the information that we receive is bad information on purpose. And I oftentimes at this stage look for information that's counterintuitive with what's going on with the price of the stock because I'm well aware that the information might be bad. So, for example, if a stock gives really good news, but the stock doesn't go higher, well, that sets off trigger and alarm bells in my head to be real careful because that good news should push the stock higher. So something else is going on, and maybe the good news isn't so accurate or is trying to mask bad news that hasn't come to the market yet, and vice versa. When bad news is coming out about a stock and it's not going lower, well, that sets off the opposite type of alarm bells for me that, geez, maybe either that was already priced in or maybe the company's doing okay because why is it not going lower when this bad news is coming out? Again, that's kind of overthinking it, getting further along than anybody needs to be. My main point is I don't think anybody needs to be any rocket scientist. Just pick companies you really like, that things you use in your day-to-day living. Products you buy for your house. Where do you go shop for them? Do you buy them on Amazon? Do you go to Target? Do you go to Walmart? These are all just fine. Drugs that you might use for headaches or whatever it is. If I'm a type 2 diabetic, there are companies that make those are companies too. You have Pfizer and AbbVie and Lilly and Bristol Myers. There are a zillion companies out there. The auto companies, what car you drive or what car do you like? And don't worry if it's the best one. I mean, I'll tell you some theories I have on some of the Fords and the GMs. I do worry about those. Again, do your own research, which is my whole point of this. Even a guy like me, maybe I overthink it, and you shouldn't be listening to it. My concern with the GMs and the Fords and things of that nature is the dealership. When you look at Tesla and Lucid and Rivian and what are the Vietnamese one, VinFast, and all these other ones that Polster that sell direct to consumer, I think the fact that they're able to not have the middleman gives them some pricing power, and the fact that they're actually the dealership and they do the repairs and everything, so they have the entire market share of their own company versus having a dealership that they're selling the cars to that are then selling to you. I think that could be a real issue for the automakers. I think that we're transitioning in time of how that system works. But again, that doesn't mean listen to me. The whole point of that story from when I was a kid is I didn't make perfect choices on it and still did extremely well. So you don't have to be perfect. You just have to have one or two that does really well, and your average will work out just fine. Take that entire investment I did, even for the one stock, that's really good return over the 35 years, which gets me back to I don't worry about the interday trade movements. I don't worry about whether I'm up or down next week or next month. When I put that money away, I've put it away. I've bought that stock the same way I buy a chair for my house. I don't expect to get that money back. I just hope one day I wake up and it's worth a good bit more than what I paid for it. That's my advice with investing. And it doesn't have to be a lot of money. The reason I picked those companies to open an account with, since they don't charge any commission to make a trade, you can buy one share of stock. So find those companies you like, look up the ticker symbol. If you don't know how to do it, make a comment in the comment section and I'll let you know and I'll take a look for it. And again, I'm going to share some stocks that I like right now and I'll tell you why as well. Because I do watch them, so I pay attention. Since my grandfather did that for us, it got me involved in the stock market and now I really enjoy it. But you can buy one share, and depending on where it's trading, maybe all you need is 20, 30, $50. And if you can put away $100 a month, or if you're fortunate enough, 100 a week, it's amazing how that'll just continue to grow. And over time, hopefully that continues to grow enough that one day you might be able to put it into treasuries or CDs or stocks that pay dividends, and you might be in the position where that can actually pay for part of your living expenses, or if you're really fortunate, possibly all of your living expenses, which is an amazing thing to do, putting little by little away over time. The get rich quick stuff is really difficult, and you don't need to worry, like, it's not realistic. Slow and steady, stick with it, 35 years, and it does just fine. So one of the stocks I like right now is Target. It's fallen from about $180 a share to around $110 a share. Its ticker symbol is TGT, so pretty similar to Target, correct? A lot of people shop there. I think even if the economy slows or anything else, in 20 years, hopefully they're still around and they're still doing well and they're bigger than what they are now. In the meantime, they do pay a 4% dividend. What a dividend is a check. They pay it quarterly. It adds up to 4% over the year. So for every share you buy, you get $1.10 each quarter. So $4.40 over the year for owning Target. And they'll give that as long as they can afford to. And sometimes they actually raise the dividend. One of the stocks I really like, and if you can save $110 or $120 to be able to buy one share of Target, that can be one of the things in your portfolio. Now make your own decisions, find the stuff you like. That was what I was saying before. I'm just sharing a couple stocks that I really like right now. And for one of the reasons I like Target is it's been in the news for having some things that aren't so great going on, but I see it a little bit differently. They're going to have to close a few stores because they've had too much theft and whatever else. Well, the news took that really badly and the stock fell a good bit, but I think that they're going to be able to close some stores that probably haven't been profitable. They're already profitable, so this should make them more profitable and put them in a better position. In some ways, I feel like it should have helped the stock, not hurt it. So that's one of the stocks right now that if you open an account at one of those trading firms, maybe you want to put in the account and start saving in. Another stock I really love is Google. Part of why I love Google is YouTube. I love YouTube. I didn't really use it a whole lot previously. My son, who I've mentioned, who's 12 years old, he's on it all the time. I started finding it maybe a year ago or so, and now I realize this is the future of television. Whether it's Google or, Amazon or some of the others, this is where people go for watching TV and getting content and everything else. And I just see that growing more and more over the future, as well as their search engine and everything else. Now, Google's trading around $140 a share. So if you're able to save $140 or $150 to buy one share of Google, well, maybe that's another one you might want to put in your portfolio. Now, one thing that I do, I'm not that guy. I don't try to own 300, 400 companies. I try to pick 10 or 20 that I like the best and then continue to invest in those unless something about the company changes. Not the price. If Google goes from 140 to 70 and I still really like Google, well, I try to remind myself to have that kid mentality of, geez, now it's half price. I can buy two shares instead of one if I saved up to buy it. Like I try not to overthink those moves and get too scared out of the market, because what I saw over those 35 years with McDonald's is it would go up, but then it would fall. And not just because of the stock split, there were plenty of times the company fell in half over the 35 years. So when you're thinking long term, you can't worry about when it goes lower and maybe see that as an opportunity to buy more shares. Now, if something's coming out that's making you change your opinion of the company and think they're no good anymore and there's some real problems, maybe if I had paid better attention to Eastman Kodak and understood that things were changing in that world, or if I understood Chrysler and the problems they were having, maybe I would have gotten out and saved some of the money and put it into other things. So there's nothing wrong with paying attention, but you shouldn't get out just because the stock price went over lower and maybe there was some news that sounded a little scary, but nothing that you think is going to really change your opinion about the company. Now, if something comes along that changes your opinion and you no longer like one of the companies you've picked, by all means, you can get out and pick something else. But my whole thing with long-term investing is I try to pick companies I think will be around for the next 35 years and just stick with them. I mean, McDonald's will probably be around too. It's not one of the ones I'm going to give you as picks, but boy, they have quite a strong arm on their industry and their market share. Maybe it is still a great investment that's going to continue to go and go and go. And I don't plan to ever sell what I have left at this point. I figure, forgive me for being a little demented and thinking, when I die, it'll be my son's, and I'll just leave it at that. So, a stock that recently came into the ones I'm looking at that I really like, but I'm a little nervous about it because it's fallen from $80 to $20 a share. And I didn't know a ton about it before, but there's NextEra Energy Partners, which is a subsidiary or a partnership with NextEra Energy, which is the energy company for Florida. Well, I like NextEra Energy Partners because it pays like a 14 or 15% dividend. And I'm a bit of a dividend junkie. I mean, I love dividends because my ultimate goal is that I hope to have enough dividends coming in that pays our bills. And I hope that that's how I could get set up. I'm hoping with NextEra Energy Partners that there aren't bigger problems going on that I'm unaware of, that they could go out of business. I do get worried when I see a company drop from 80 to 20, as much as I say don't worry about it, especially because NextEra Energy Partners isn't one that I'm really well familiar with or that I know a ton about. With Target and Google, I feel a lot more comfortable about their companies simply because I know more about them. At the same time, I will take a shot on NextEra Energy Partners because I think everything's okay, and the information in the news that I read didn't sound so terrible that I think they're going out of business. I give you all of that because really you need to do your own research, and I don't want you trusting me on something like that because I don't know enough about what's going on to give it as good advice without worrying that, you could lose your money in it. And I don't want anybody to ever feel like I gave advice on something where it was real bad like that. But the stock's trading around 22 or $23 a share. So if you have $100 you can put away, you can buy 4 shares of it, and you get 15% return. My real attitude with that one is, if they have the ability to pay that dividend, I'll never sell the shares that I bought. I would be thrilled to get a 15% dividend payable, in increments of what, 4% or so every quarter. That's incredible return to be able to get as a dividend. Now, generally, when something is giving that much in return, it's because something's going on and they probably won't be able to continue to make that dividend. The reason I like Nextera is what I read in the news. Now, they had fallen from like 80 to 50, and when news came out that they didn't expect to be able to grow at the pace that they had predicted, which was like 12 to 15%, that they plan to be able to raise the dividend going forward. And now they're estimating that they will only be able to raise the dividend payments by 5 to 8%. I, I'm thrilled at what it's paying now. I'm not so worried about if they have any ability to grow the dividend. So if the news is accurate to what I read, boy, I'm thrilled to buy it where it is. I just don't know if the news is accurate to what's really going on, because sometimes things are worse than they seem. The thing that I find interesting is the news has come out, the stock fell, and it seems to have created a base down here. I'm just hoping it doesn't get below 19 or 18 and start worrying me that something else is going on. The other thing is they report earnings next week, so I'm hoping that gives me some indication as to whether things are okay or not. But that's another stock I like, that if you guys open an account at SoFi or something else, its ticker symbol is N like Nancy, E like Edward, P like Paul, and that one is Nextera Energy Partners. And I really like that company as well. Forgive me, I flipped around. The sun was beginning to become a problem. So another stock that I really like is Pfizer, and I also like Bristol Myers. They're both big drug companies. What I like about Pfizer is it's fallen from about $60 to $30. They've had to lower their guidance for earnings, but they're just a huge company, and I don't really see them going out of business. And they're paying a 5% dividend. Bristol Myers has had a rough go of it too, and it's fallen to a little below $60. And I think the same thing. I think they all got blown up so much during COVID with the vaccines, and just drug stocks often become security in rough economies because they tend to still be profitable even when other things are struggling. So they got overpriced, I think, for a little while, and now I'm guessing they've come back to about where they should be, and it's probably fair value. And as I mentioned earlier, I really like dividends, and they both pay a dividend. I don't picture them being something that really does huge success or goes up a whole ton or you become a zillionaire buying it, but I think they're slow and steady type of companies that I don't really picture having too much trouble in the future. Maybe they do. So pick what you guys like. I really encourage you looking at what you use in your daily life and the things that you think are really good products. I find that good products do well over time, or where you shop, which is part of what I like about Target. That's partly why I like this other one that I have as well, which is Amazon. Similar to to Google, what I found is once I found Amazon, I do a lot of my shopping there. I buy a lot of products on Amazon. Their returns are really easy. Their products are just fine. You order it and it shows up at my doorstep. I don't even have to go anywhere or fight the lines or anything like that. I don't buy everything there, but it's amazing over the years how once I found Amazon and once I got used to it, and then on top of it, we use the dots and the echoes, and we have Prime and watch the TV shows and everything else. So I think they have a good share of that market space, and I think they'll do just fine as well. So Amazon, the ticker is AMZN. it's trading $130 a share. If you're able to save up and buy one share of Amazon, I think that's another one I would want to have in a portfolio. And one other stock that I've seen that has had a rough go of it that I like is Disney. Disney's been in the news. They've been struggling. They haven't been making as much. There's certain parts of the company that there's concern about, and it's fallen pretty far into like the low 80s. Well, I think between their theme parks and ESPN and a lot of stores and things that do just fine, that no matter what happens in the long run, Disney will figure a way to make more money and continue to be profitable. And I have faith in them as a company. They're something I want to own for the next 20, 30, 40 years. And I'm comfortable saving up and buying one share at $85 or wherever it is in the hopes that in 10 years, maybe it's doubled or maybe not, but I don't overdo it. And I think they're a good, slow, and steady company that I would have picked when I was 16, 17 years old as well. Right back to the story of what I look for. And since they've had bad news and they're out of favor and the stock's fallen, maybe I'm lucky and this is a good price to get it at. Which brings me to the last stock I'll pick. A little bit of another one that's a bit risky because I don't know, maybe things are legitimately changing. But Cracker Barrel has pretty much fallen in half. Their ticker symbol is CBRL. Another one that pays a dividend, and right now it's paying over 7%, which to me is incredible. So if they're able to continue that, now their sales have slumped with the economy slowing, they have some concerns, and they may not be able to continue to pay that dividend, or they may have to cut it. So, and also so you guys understand, a dividend is not a guarantee. If a company starts running into trouble, they might cut it out completely because they need to save the money, or they might lower the dividend payment or things like that. But Cracker Barrel is another one I really like, partially because I have good memories of it. When I would drive cross country, that was somewhere we would stop and I would get something in their little store more than I really loved the food. I mean, they have these little candies that are just like sticks and they have different flavored of essentially it's a hard candy that you suck on and eat the stick, and they were like 10 cents. I don't know what they cost now. I haven't been in a while, but I just have fond memories of that, and I figure there's probably families that still drive across the country, and when they want to stop somewhere, maybe Cracker Barrel is one of their stops. Maybe kids still buy some of the candy or something in those little stores. I hope they don't go out of business. I hope they can continue to pay the dividend. It's fallen to a little below $70 a share. So if you can save up $70 over a few weeks and buy one share of Cracker Barrel, that'd be cool too. So really in the end, my goal is to let you guys know you don't need tens of thousands of dollars or hundreds of thousands of dollars. You can start with $25 and buy one share of NextEra Energy Partners, or $70 to buy Cracker Barrel, or 130 or 140 to buy Amazon or Google. It doesn't have to be a ton of money. It's just getting involved and starting to save and starting to learn about it. And the younger you can do it, the longer your time horizon is to accumulate more. I know it sounds old fashioned. I know it's not glamorous. I know it's not fun. But when I was a kid, I wouldn't go certain places because I would save. I'm really glad I did it now, but there were things I didn't get to do while others were. But some of it is foolish. I don't need a $6 drink at Starbucks. I don't. To be perfectly honest, I have an espresso because I love it more than the K cups. But I actually take the Nespresso things and fill them myself and put a lid on top because I'm not about to spend $2.50 or $3 for what they charge for one little pod when I can fill it myself and put a lid. The lid's 10 cents, the pod's free because I bought one pack of them before, and maybe I'm putting 15 cents of coffee grinds in it, and it makes wonderful coffee. Like, it's really good coffee. And I'm cheap enough that I'd rather spend 20 or 30 cents for my cup of coffee than the 250 because I drink a lot of coffee. Anyway, it's a little off topic, but my overall point is if you save a little bit to put away a little bit, hopefully in the long run, you'll be really glad you did it. And hopefully, you find yourself in a position where retirement doesn't become as stressful as it might be for others because you have accumulated some money that can help pay some bills. Anyway, I'm going to remind you guys again, do me a favor, give a thumbs up, like, and subscribe. It really helps the algorithm. I hope you enjoyed the video today. If you want to open up an account at SoFi, there'll be a link in the description. But, Fidelity's good too, and E-Trade's really good. They all have free platforms for trading. And if you're having any trouble on any of it, just make a comment. I'm happy to talk people through. But make your own decisions. If you have more and you use a financial planner, by all means, communicate with them before making any financial decision that anybody on YouTube makes. I mean, really, you should be listening to us because you find it interesting and you like the content, but you should really be doing your own research and not trusting everything out there. I mean, I'll tell you one last thing. I know real estate looks expensive too, but I want to own my home. I'm not looking to jump right in or bite off more than I can chew or anything else. It's not self serving because a stock market correction would be better off than not. Anyway, I'll shut up. I was going to talk about stocks today. So enjoy your Sunday. Have a great week. Hopefully, I've encouraged somebody to get out and go open an account and start saving. Have a good day.